The Monetary Policy Committee held its 126th meeting from September 15th to 17th this week to evaluate recent economic developments and assess risks to the outlook for inflation and growth. And this briefing summarizes the key discussions and the committee's decision on the monetary policy stance. Contrary to earlier projections of a global economic slowdown, growth has been resilient, supported by modest tapering of the tensions associated with the tariff wars, robust exports in the first quarter of the year, easing credit conditions, and fiscal expansion in some advanced economies. Against this backdrop, the IMF revised its global growth projections for 2025 to 3.0% compared with earlier forecasts of 2.8%. This notwithstanding, geopolitical uncertainties, relatively high tariffs, and projected decline in global trade could dampen near-term growth prospects. Global inflation is expected to decline amid lower food and energy prices, as well as a slowdown in employment growth. In addition, global financing conditions have eased somewhat, supported by declining policy rates, lower long-term bond yields, and a strong rebound in portfolio flows to emerging markets and developing economies. Also, current global conditions and uncertainties have led to a strong rebound in gold prices, with positive implications for Ghana's external sector position. Now, on the domestic front, the economy continues to demonstrate strong growth, driven largely by the services and agriculture sectors. And the latest release from the Ghana Statistical Service for the second quarter of 2025 shows the economy posting a real GDP growth of 6.3% compared with 5.7% recorded in the same quarter of 2024. Now, excluding oil, GDP grew at a much faster pace by 7.8% relative to 5.7% over the same comparative period. The services sector grew by 9.9%, while the agriculture sector expanded by 5.2%. The bank's high-frequency indicators continue to point to sustained momentum in economic activity. The Composite Index of Economic Activity, or what we call the CIEA, recorded an annual growth of 6.1% in July 2025, compared to 1.9% in July 2024, on the back of international trade activities, consumption, and industrial production. The latest confidence surveys that we also conduct, this time was conducted in August 2025, also reflected sustained improvement in sentiments. Our consumer confidence index also remains strong, despite some softening of the index, while business confidence further picked up as firms met their short-term targets and expressed optimism about company and industry prospects. Similarly, Ghana's Purchasing Managers Index, or the PMI, went up in August, signaling increase in new orders as business conditions improved. Now, on inflation continues to ease and has been broad-based. Headline inflation declined further to 11.5% in August 2025, down from 12.1% in July, the lowest reading in 4 years. The sustained decline in inflation for 8 consecutive months was largely driven by a combination of factors, including the prudent monetary policy stance, the strong liquidity management, appreciation of the cedi, fiscal consolidation, and improved food supply. The bank's main core inflation measure, which excludes energy and utility items, also declined, reflecting continued easing of underlying inflationary pressures. Similarly, inflation expectations among consumers, among businesses, and the banking sector all eased, affirming the disinflation process going forward. On interest rates are declining on the money market in response to the recent cut in the monetary policy rate. Yields on the money market instruments have declined significantly, and the average lending rates are gradually easing, which should lower the cost of credit in the near term. The interest equivalent of the 91-day Treasury bill instrument eased from 13.4% at the end of July 2025 to 10.3% at the end of August 2025. The average lending rate over the same period went down from 26.6% to 24.2%. Now, fiscal policy implementation in the year to July 2025 reflected strong consolidation efforts underpinned by tight expenditure controls, although revenues fell short of target. Consequently, the overall fiscal deficit on commitment basis was 1.1% of GDP, outperforming the target deficit of 2.1% of GDP. Also, the fiscal anchor, and that is the primary balance on commitment basis, recorded a surplus of 1.0% of GDP, reflecting a better outturn than the targeted surplus of 0.5% of GDP. The deficit was largely financed from domestic sources. At end July 2025, the total public debt stood at 44.9% of GDP, down from 61.8% of GDP at end December 2024. Now on the banking sector. The sector recorded strong performance over the first 8 months, with continued asset growth and improved profitability, asset quality, and efficiency indicators. The industry's capital adequacy ratio, or the CAR, without regulatory reliefs, increased to 17.7% in August 2025 from 10.2% in August 2024. The industry's non-performing loan, or the NPL, ratio improved to 20.8% compared to 24.8% last year. And this was due to growth in bank credit and contraction in NPL stock. This notwithstanding, elevated credit risk remains a major concern going forward. And in the outlook, adherence to the recapitalization plans and full implementation of the bank's regulatory guidelines to lower NPLs will further enhance resilience of the banking sector. Now, on the external sector, the sector strengthened in the first 8 months of 2025 with a significant trade surplus of $6.2 billion compared to $2.1 billion which was recorded during the same period in 2024. This was driven by a sharp increase in exports earnings, mainly gold and cocoa, which far outpaced import growth. The reserve position remains strong with our gross international reserves at $10.7 billion. That is equivalent to 4.5 months of imports cover as at end August 2025, compared with $8.98 billion, which was equivalent to 4.0 months of imports cover as at end December 2024. In the outlook, the external sector is projected to broadly remain resilient, anchored on favorable commodity prices and improvement in remittance inflows. Now, on the back of the strong external sector performance and increased reserve accumulation, the cedi strengthened against the major trading currencies in the year to July 2025. Subsequently, the cedi came under some demand pressure, bringing the cumulative appreciation through 12th of September 2025 to 21.0% against the US dollar. And let me point out that the cedi remains among the strongest currencies globally year to date. And this reflects prudent monetary policy, effective liquidity management, fiscal consolidation, and increased foreign exchange inflows. So given the current state of macroeconomic conditions, the view of the committee was that inflation will continue to ease in the near term. And in the outlook, headline inflation is expected to drop to within the medium-term target of 8 plus and minus 2% by the end of the fourth quarter. However, the possible upward review of utility tariffs could exert some price pressures in the medium term. Notwithstanding this, maintenance of an appropriate monetary policy stance, strong sterilization efforts, ongoing fiscal consolidation, and adequate reserve buffers should sustain the disinflation process. Given these considerations, the committee, that is the MPC, by a majority decision, voted to lower the monetary policy rate by 350 basis points to 21.5%. The committee will continue to monitor macroeconomic developments and take appropriate policy decisions as and when necessary to reinforce the disinflation process. Now, let me also announce an additional measure on the net open position limits for banks. The decision has been made for the single currency NOP limit, which has been plus and minus 5%. This has been revised to between 0% and minus 10%, which will be effective from the 1st of October 2025.